Imagine waking up one morning and realizing $20 billion has vanished. Not stolen, not hacked, just gone. In March 2021, Wall Street watched in shock as one man's secretive investment empire collapsed in just 48 hours. Banks lost billions, stocks crashed, and one quiet hedge fund manager triggered one of the biggest hidden financial disasters in modern history. This is the story of Bill Hwang and the mysterious collapse of Archegos Capital Management. Bill Hwang wasn't a celebrity billionaire. No flashy interviews. No yachts on Instagram. In fact, most Americans had never heard of him. But inside Wall Street, he was known as a quiet trading genius. Hwang was once a protege of legendary hedge fund manager Julian Robertson. After working at Robertson's famous hedge fund Tiger Management, Hwang launched his own firm. But after regulatory troubles, he shut it down and quietly created something new, a family office called Archegos. And this is where the real story begins. Archegos wasn't like normal hedge funds, because technically, it wasn't a hedge fund at all. As a family office, Archegos managed only Bill Hwang's personal wealth. That meant no public reporting, no transparency, almost no oversight. But here's where things get dangerous. Hwang wasn't just investing his money. He was borrowing massive amounts from banks through complex derivatives called total return swaps. These allowed Archegos to secretly control huge stock positions without publicly owning them. To Wall Street, everything looked normal. But behind the scenes, Hwang had built one of the most leveraged positions in financial history. At one point, his bets controlled tens of billions of dollars in stocks, and the entire structure was balanced on one fragile thing: stock prices continuing to rise. In March 2021, something small happened. A few stocks started slipping. Companies like ViacomCBS and Discovery Inc. began falling. Normally, that wouldn't be a big deal. But for Archegos, it was catastrophic. Because of the massive leverage Hwang used, even a small drop triggered margin calls. Banks demanded billions in cash. Immediately, Hwang couldn't pay, and suddenly, Wall Street banks realized something terrifying. They had all lent huge amounts to the same client, and none of them knew how big the risk really was. Now every bank had the same thought: sell first, before everyone else does. Within hours, banks started dumping Archegos stocks into the market, billions of dollars worth. It triggered a massive fire sale. Stock prices collapsed, and the losses spread like wildfire. One of the biggest hits came to Credit Suisse. The bank lost over $5.5 billion. Another major loss came to Nomura Holdings. Meanwhile, other banks like Goldman Sachs and Morgan Stanley managed to sell early and limit their damage. But the total destruction was staggering. In just 2 days, more than $20 billion in value disappeared. One of the fastest financial collapses ever recorded. And the shocking part? Most people had never even heard of Archegos before it exploded. When the dust settled, the financial world asked a simple question: how did this happen? How could a single private investment firm secretly build positions so large that when it collapsed, it shook global banks? Regulators launched investigations. Executives were fired. And the story of Bill Hwang became a warning about the hidden risks inside modern finance. Because sometimes, the biggest financial disasters aren't caused by famous companies or global recessions. Sometimes, they're caused by one man, one strategy, and 48 hours of chaos. And the scariest part? The system that allowed Archegos to collapse still exists today.